So for the last year, everyone assumed that as AI tokens got cheaper, enterprise software bills would naturally shrink. But Palantir just proved the exact opposite, pulling in a record $1.63 billion this quarter. Welcome to Earnings Unscripted. It is May 4th, 2026, and we are unpacking Q1 for Palantir, ticker PLTR. And Miro, I feel like I am looking at numbers that do not belong in the same dimension.
They barely belong on a spreadsheet. Look, you have revenue up 85% year over year, which is huge. But the operating income is what stopped me. $984 million adjusted. That is a 60% margin. It gives them a Rule of 40 score of 145%. I actually had to run the math twice just to be sure I was reading the release right.
145. Okay, before we dive completely down that rabbit hole, quick reminder that this is an entertainment podcast. These are just our personal opinions and absolutely not financial advice, so please do your own research. But a Rule of 40 score at 145 is absurd. You would think the market would be throwing a parade.
You would, but the reaction is actually quite muted. Sort of weird. The stock took a pretty sharp dive right 5 o'clock Eastern when the call started. It dropped from roughly 147 down to 142 in the extended session. It ended up closing after hours down about, down 1.38% to be exact. The tape is just shrugging off a 16% sequential revenue growth.
That is so strange because under the hood, the underlying story is practically science fiction. Earnings came in at 33 cents a share adjusted, which is great, but the way they're getting there is what fascinates me. Their CTO, Shyam Sankar, had this whole thing about the Jevons Paradox. Like the cost of AI compute drops 1,000 times, and instead of saving money, companies just spin up 10,000 times more AI agents. He actually called tokens the new coal.
Which is exactly why their margins are exploding. They aren't just selling software licenses anymore. They are selling infrastructure for, an army of automated agents. And they are eating their own cooking here. Sankar mentioned they completely ripped out their own expensive legacy CRM and rebuilt it natively on their AIP platform in a matter of months.
Okay, literally killing off the legacy software model inside their own house. And that totally tracks with Alex Karp casually dropping that they only have 70 salespeople total. And apparently only 7 of them actually really sell. 7 sales reps driving a $1.6 billion quarter?
Yeah, normal companies this size have 7,000 reps? U.S. revenue alone was $1.28 billion. That's up 104% year over year. The product is just bypassing the traditional procurement cycle entirely through their engineering bootcamps. The engineers prove it works, and the client buys it.
All right, let's get right into the details on that. I want to understand how a skeleton crew actually manages $1 billion run rate without breaking.
Well, they manage it because they aren't actually, selling software. They're deploying prototypes.
Like those boot camps they keep talking about?
Right. They send in an engineering team, hook up the client's actual live data to the platform, and just let the product prove itself in an afternoon. And the financial proof is, it is sitting right there in the net dollar retention. It jumped to 150% this quarter.
Okay, wait. 150%? So that means existing customers just spent 50% more this year than last year?
Just naturally, without needing a massive sales force to push them. Exactly. Because the expansions are so drastic once they get inside the plumbing of a company. Let's look at Shyam Sankar's telecom example from the call. He brought up a telco dealing with 10 million furious customer calls a year.
Which sounds like a standard Tuesday in telecommunications.
Pretty much. Now, the traditional enterprise software approach is you buy an AI chatbot to take those calls, to deflect the angry customers and save on call center headcount. But Sankar said something fascinating. I am quoting here. He said, don't use AI to reduce calls. Use it to generate them.
Use it to generate calls to people who are already mad?
Yes, exactly. They built an autonomous AI advocate that proactively reaches out on the customer's behalf to fix the issue before the customer even thinks to call. They basically took a defensive cost center and turned it into a proactive customer loyalty.
That is so wild. It is a completely subtle shift, but I mean, it is a massive structural change. You're not building a wall against your users anymore.
Yeah, and that is exactly why you don't need 7,000 salespeople. If you go into a boardroom and prove you can fix a 10 million call problem practically overnight, the executives are just asking where to sign. But look, it's not completely risk-free. I don't want to paint this as perfect.
Right. So where are the cracks forming? Because 150% retention is, hard to maintain forever.
It is. And the first crack is customer concentration. Their top 20 customers accounted for an average of $108 million each over the trailing 12 months.
Wow, $108 million per client. That is extremely top-heavy.
Very top-heavy. If just one of those mega contracts hits a snag or stalls out, the run rate takes a serious hit. And the second issue is just scaling that skeleton crew. The bottleneck isn't demand, it is finding enough elite engineers.
Sorry, the CFO mentioned that too, right? Blazer said something about expenses ramping up.
He did. Q1 adjusted expense was already up to $649 million. He made it very clear they are aggressively hiring technical talent for the rest of 2026 because you can't just throw normal sales guys at a platform that requires military-grade deployment.
Speaking of military-grade, there was another layer here from Alex Karp that it was so blunt. He was talking about customer loyalty and essentially told his commercial clients that Palantir is, his word was, monogamous. Like, they absolutely will not commoditize their clients' data.
Oh yeah, he specifically said, "We are highly monogamous in the way we work." And then he immediately followed that with, "The only thing we will put above you is the U.S. national security."
Which is just the most Alex Karp thing to say to a Fortune 500 CEO. You are my priority right after the Department of War.
But it absolutely works for them. That unapologetic stance, it is practically a defense moat. Commercial clients see the U.S. Navy cutting their supply chain approval times from 200 hours down to 15 seconds using Palantir. And they want that exact same battlefield reliability for themselves.
They are basically underwriting their enterprise software with the hardest possible national security problems. So if that is the underlying engine driving all this efficiency, where does this leave them heading into next quarter and the rest of the year?
It leaves them practically obliterating their own prior numbers. They just raised the full-year revenue midpoint to over $7.6 billion, and Q2 alone is pegged around $1.8 billion. But the outlook is not really about the math this time. It is about the physical limit of their model.
What do you mean by physical limit?
Karp literally said they don't have to have all the market because they are capped. He is pushing the company to do 100% growth in the U.S. again next year, but they are essentially bounded by supply limits. The demand is there. You just can only deploy so many elite engineering teams at once.
Wait, so the bottleneck isn't getting customers to sign. The bottleneck is actually installing the software?
Exactly, and that is the friction point going forward. The CFO actually hedged a bit on the rest of the year because, expenses are going up. Q1 operating expense climbed 7% just to aggressively hire technical talent. You can cut the traditional enterprise sales team, but you absolutely have to pay up for the mechanics.
Right. The mechanics who are literally building these AI agents on the fly during the bootcamps. That talent is definitely not cheap.
No, it is not. And a lot of it comes through stock-based compensation. That hit $202 million this quarter alone. Investors are forgiving the dilution because the adjusted cash flow is just so massive right now, but it is a real underlying cost.
Always a catch. Still, you really have to hand it to them. Everyone was terrified that cheap AI models would compress software revenues. Palantir completely flipped that script. They proved cheaper compute just means an exponential explosion in automation.
Yeah, Karp called the rest of the market AI slop, but Palantir actually built the assembly line.
Okay, I am absolutely stealing that. Replace the slop with the assembly line. I think that is a perfect, somewhat poetic place to leave the numbers today. Thank you for making sense of it all, Miro.
Anytime. See you all after the next print.
And that is it for today. So if you want these little earnings chats to just, show up automatically, go ahead and follow the podcast. Just as a quick aside, Earnings Unscripted is an AI-generated experiment, and it is honestly pretty wild how the voices actually take little breaths between thoughts. We would love to hear what tickers you want next, so drop a note to Earnings Unscripted at datamanus.ca or grab the X link in the show notes. Thanks for hanging out.
Catch you next time.